If you're a business owner, you've probably thought about setting up a 401k plan or you already have one for your business. In today's episode of Cuppable, we're going to break down some lessons and some advice for business owners on how to set up and manage a 401k plan. Today, I've got with me Patrick Fontana, the founder of Fontana Financial Planning. Welcome, Patrick.
Cheers, Michael.
Cheers. So, Patrick, I know what inspired this idea of this video is a phone call that we just had with a 401k expert who kind of brought up some ideas and some considerations that I know you've been managing 401k plans for over 20 years now. And I know you have a lot of experience personally with some of the examples or ideas that were brought up. So, to start, let me just turn it over to you to talk a little bit about some advice. If a business owner came to you and said, I'm thinking about starting a 401k plan, what sort of advice you would give them around how to set it up?
So depending upon the industry, right, the layout of the office and the type of employees, the advice is going to vary a little bit. So I'm going to use what we're most comfortable in, what our kind of box is, which is very similar to our firm, right? So small number of employees, 10, typical dentist, orthodontist, small business owner, where there's a fairly small office. And the goal is multifaceted, right? It's to have retention, to help employees, and to get a tax break, be able to save more money. So when we've laid out these plans, you start with what's the goal? Is the goal all these things? Is the goal to put away the most money possible for the owner and the least amount for the employees? Is it meant to be inspire people to give, like where they have to save? They have to put away money to get money, or do you just put away money for everyone?
I know a big thing that we've talked about is as the business owner, kind of protecting the employees from themselves in some ways. So, can you talk a little bit about some of the ideas or some of the advice you'd give somebody as far as like how do you protect your employees from the 401k plan?
Absolutely. So my opinion on this has gotten a lot stronger over the years to where now, when we set up a plan, I push heavily to just don't allow loans, protect people from themselves. Because I've seen too many times where, one person in the office hears from somewhere that they should take out a loan, and they've built up 40,000 bucks in there, and they pull out 20 to buy a boat, which immediately, depreciates, or some purchase that's probably not too wise. And then their paycheck is handicapped to pay back the loan to their 401k. The business owner, who's a lot of times doing the payroll, has to deal with another calculation and another payment, and just not allowing loans, period. They're never a good idea. And doing, I shouldn't say never. I've not found a case where it's a great idea to do a 401k loan. So just don't allow them in the first place.
Yeah, one thing I'll add too is just having a good game plan as far as education. A lot of times employees don't understand the value of what they're getting unless they're educated on it. And I'd say that's one thing that we try to be very intentional on any of the 401k plans that we are the advisor on is going in to the orthodontics office or whatever it might be, having a meeting with all of the participants to explain what's the vesting schedule, what are the investments, how does this work long term when I ultimately retire and I want to take it out? And then one thing that I'd say is really important and often overlooked there is it gives us the opportunity to pat the business owner, their boss, on the back and talk about how great they are by reminding them of all the money that was put in on their behalf. And that can be in the form of a match, like a 3% safe harbor match. It can be in the form of a profit share. This time of year is profit share season where all of the administrators are running calculations and we're getting back like, hey, all of these employees are getting this much money into their 401k plan. And it's a big opportunity that a lot of people miss, and a big opportunity that we like to take advantage of telling everybody what a great boss they have and they're putting in X $1,000 into their plan for them.
So I asked Michael a little bit earlier, we had our spreadsheet back from that exact activity to see, okay, what does the profit sharing numbers look like? So as a business owner, most of the profit sharing is discretionary, meaning you decide to do it or not, right? So we had a good year. We've made good money. We're going to pay a lot of money in taxes. We're deciding to max out our profit sharing plan. So what that means is for me to get the most money into my plan for myself pre-tax, I have to put away money for the employees. And it's basically, in our case, 6%, right? So $100,000 employee gets a $6,000 profit sharing contribution. And that's smart to do from a retention point of view, from a sharing the wealth and encouragement, and just, being a good steward of running the firm. And that's on top of a 3% safe harbor contribution that we put away for everybody. So a $100,000 employee this year got $9,000 from the firm that's been invested and grown nicely, right? And so at the end of the day, that's powerful. And we look at employees that have started in a plan with no money saved anywhere. We've done the enrollment meetings, signed them up. They've done their part and said yes and signed up to do X percentage into the plan. And then they've made more money over the years, say 10% becomes a bigger and bigger contribution. Fast forward a few years, boom, there's a bunch of money built up. And then they do take the move to change jobs or retire. And that money is awesome and really empowering for them for the rest of their life.
Yeah, the last thing I'll add is if we talked about different goals. If the goal for you as the business owner is to maximize how much money you can put away into your own 401k plan, I'd say part of that is just having a game plan for like how you're going to do that and having that in the context of your bigger overall financial plan. So an example I would give is if you have a significant pre-tax retirement account already and setting up a 401k where you're only doing pre-tax, pre-tax, pre-tax. And sometimes you'll even get approached about being able to do a defined benefit plan where you can put significant, $270,000 away pre-tax in a single year. And you get drawn in by the tax break, understanding the longer term picture of how that plays out when you have millions and millions of dollars in pre-tax money that ultimately at some point is going to get forced out through required distributions or when it's passed on to the next generation and they have to take it out over a 10-year window, and also recognizing where the tax rates are today compared to where they've been historically and where they may one day get back to. That's a mistake that I'll say it's situational, but it's a mistake I'll say we've seen people make is they get too focused on the tax deduction today and they ignore the fact that this money pre-tax, pre-tax, pre-tax is going to grow to a very substantial amount that could be forced out over a period of time that they have no control over.
So little this isn't really negative. One of them's negative, but little add on here is when you set up the plan. One thing that I've seen people do I advise against is to be too flexible about making changes and when people get in and get out, because that puts a lot of work on the business owner. So having some waiting period where people have to be hired and work a little bit before they're in the plan, and have say twice a year that they can enter or exit the plan rather than just all the time adding people, taking people out. The other thing that's been a little bit of a depression thing, I was back up several years when my dad had a government contracting company and set up a plan, and he had a few employees that made the big mistake pretty early on of leaving and taking out their money, right? They left the job and then they immediately called, and the money that my father had put away in the plan for them was, one case I'm thinking of in particular, pretty significant, and immediately just wanted to get at that money, right? So she was young and she paid income tax and a 10% penalty, and the money was gone immediately on not a great purchase. Came around to bite her in the tail next year. This is a friend of my dad that worked for him and hired her. The tax bill came the next year. She didn't have any money to pay it. And so blowing out of your 401k when you leave a job, especially as a young person that just no one told them or whatnot, it's a very common mistake. It's always painful for the business owner to see that happen. It's painful for us as advisors to see that happen. When you change jobs, roll your 401k to the new job, roll your 401k to an IRA, get advice on what to do with it, be very slow. And I'd say never tap into that when you're paying income tax and a 10% penalty. It's really stunts your growth, stunts all the progress you've made. And it's a big mistake that's very common.
If you have questions about your situation and how some of this advice may apply to you or your business, we'd be happy to talk to you. So we have a link down below in the show notes where you can schedule a time for an introductory call with a member of our team. And with that said, Patrick, how do you want to wrap us up today?
Rebalance until rich in your 401k.
Cheers.